Yesterday's aggregate purchasing manufacturers indexes for Europe suggest it's almost inevitable that the Eurozone did actually return to recession in the third quarter. A good gauge of economic growth, the market's Eurozone composite PMI fell to 46.1 in September. That's from 46.3 in August. For more on this and other major stories influencing the global markets, we're joined by Larry Shover, Chief Investment Officer at SFG Alternatives. Larry, good to see you there. Well, this result, I guess, largely in line with expectations, but surely it's a concern that after all of these good intentions announced by the ECB and the Fed, all of these efforts spoken to stem the debt crisis in Europe, there's clearly still so much uncertainty hanging over business investment and spending.
You know, that's a great point, Julia. I mean, right now we have the ECB, the FOMC, Bank of Japan, Bank of England, all making statements or policy moves. And we had Hewlett-Packard come out just a couple hours ago in the U.S., like just managing expectations to the downside. But yet the equity markets just don't want to hear about it right now. It seems like the overwhelming driver right now is the OMT. And the fact is that seems to be providing stability to the market. People do expect Spain to ask for help. It's not when, but what's going to happen with the OMT response. It seems like right now we're pricing in just a lot of stability. The market is ratcheting higher. We had two good eco numbers this morning in the U.S. and just gave fuel to the fire. But there doesn't seem to be a bit of concern right now. And to me, that scares me.
So do you think that the formal bailout request from Spain, I guess, when it comes rather than if, will be a catalyst for some sort of improvement then?
Yeah, it seems that way. And it seems like the market agrees right now. It seems like, again, the question isn't like if they're going to ask, it's when they're going to ask and how is the OMT going to respond or the ECB is going to respond to that. And it seems like it's favorable right now. I mean, one thing you need to look at in the U.S. is that all sectors of the market were up today except for energy. And obviously energy was down because oil was down 4%. There seems to be a lot of confidence in the market and for things to go really well in the next few days, and especially over the weekend in the U.S.
And we're keenly watching this FOMC minutes, of course. What are you looking out for in the statement?
Yeah, well, at least in the U.S., for the FOMC, I think people are looking at when's the Operation Twist going to end, and when it ends, what's going to happen. Also, I think they're looking for Bernanke to make some positive or negative statements on how long rates are going to stay low, like what the target is. Are we looking at 5 or 7% unemployment, or are we looking at 9% unemployment? I think people just want a credible roadmap. But again, it seems like either people don't care right now or they're just deeply convicted that Bernanke is going to deliver with some type of credible response thereof.
And how significant, Larry, is this non-farm payroll data for September going to be? I mean, given that we're in the lead up to the US election, heading towards that fiscal cliff.
Yeah, so right now it seems like the market is priced in. This is an American way of looking at things, but this fiscal cliff is going to turn into what we call a fiscal hill. It's going to be a lot less of a debacle than we're thinking of. And that's clearly because we in America have just a tradition of just kicking the can down the road, punting the ball down the field, whatever you want to say. But it seems like, again, the market is just insisting upon the fact that this probably won't be taken care of right now, but enough measures and safety measures will be put in place just to allow them to operate in the short term.
And of course, I did see a note on our own stimulus efforts, debate over our monetary easing, the RBA surprising many economists by cutting rates by 25 basis points. But trade deficit data out yesterday, I guess, really seeming to justify the RBA's move from a lot of perspectives.
Yeah, and so you guys lowered your rates by 0.25%. That was not a surprise to the typical Americans because we feel like everybody's accommodating right now. And clearly it wasn't a surprise to Macquarie, who actually called that a few weeks ago. But the reason why you're doing it might be different than what we'd expect. I mean, I think it was more, at least from an American perspective, it seems like it was begrudgingly done. It was done because it's really hard for exports right now. And your perception of what's going on in China is perhaps different than ours. And I don't think you guys lowered by 1/4% casually. It was done very begrudgingly. And again, just shame on me, but that's coming from an American point of view.
So when you say that our opinion on China is different from yours, you're far more bullish on China's growth?
Yeah, I think in America, we're just so used to this entitlement culture that we've developed, especially in the last 4 years, that we're just accustomed to the last 3 quantitative easing programs, that China is going to continue to announce these gigantic infrastructure projects, which, by the way, I think they did this morning with some big railroad projects, but they will continue to do so. That will support metal prices, and we've seen nickel being supported, we've seen steel, and obviously copper was down today, but copper has been stubbornly high because I think the market has priced in that China will invent some very, very large infrastructure projects, and obviously Australia will be a recipient of that.
Larry Shover from SFG Alternatives, thanks so much for your time today.
You're welcome.